All right, well, my clock shows it's 1 minute after 1. Why don't we go ahead and get started? My name's Todd O'Hare. Make sure I unmuted. I'm the president and CEO of the Montana Chamber of Commerce. Our office, like a lot of offices today, are all working remotely. We want to welcome everyone for joining here today. We try to do a webinar about every week or so, kind of based upon some of the information that may be coming out relative to some of the federal programs and some of the shifts that have taken place over the course of the last couple of months in response to the COVID-19 outbreak. And so this is an opportunity, we think, to kind of talk about one of our partners, Pentegra, and the retirement plan that we've partnered with them on. One of the things that we see in workforce development as a challenge is that employers are talking more and more about the employee needs for more than just a salary, more than just an hourly paycheck, is that they're looking for a variety of benefits. And obviously retirement is an increasingly important benefit that employees are looking for with any sort of a job that they take. And so there's an opportunity with these sort of programs like this here to take some of that stress and some of that administration off of an employer's plate through a plan such as Pentegra has here, and take all that liability and stress out, and then be able to offer your employees an opportunity for contributing to a retirement plan. So we're happy to have the folks with us today representing Pentegra in this effort. I'd like to introduce Mike Mumford, who we've been working with over the course of the last several years. Mike's got a lot of experience in the world of retirement and finance, education, and planning on a variety of fronts. And so we're glad to have Mike with us. And so Mike, why don't I turn it over to you, and you can introduce our speaker today. We can kind of start going through the program. Mike?
Perfect. Thanks, Todd. And thanks to all of our guests that have joined us today. A number of years ago, the Montana Chamber had the insight to create a retirement plan program for its members called Montana Retirement Choices. And the goal really was to reduce the workload and responsibilities and liabilities associated with running a corporate retirement plan, and also for improving the education and understanding and outcomes for the employees. The Chamber chose us at our team at UBS. We are a senior retirement plan specialist team at UBS Financial Services, and Pentegra to administer the program. Pentegra is very unique in the retirement plan industry. They are one of the very few folks that can be a full scope fiduciary on a 401k plan to transfer significantly the risks and responsibilities to outside plan professionals. Today, we're joined by Rich Rausser from Pentegra, who's a 30-year veteran of the retirement plan industry. He's the Senior Vice President for Client Services, and he's going to be addressing the aspects of the CARES Act that affect corporate retirement plans. Rich, take it away.
Mike, thank you for the introduction. Todd, thanks for opening up the opportunity to speak to the group. Happy to be here today, and today our topic is the CARES Act. This is the Coronavirus Aid, Relief, and Economic Security Act. This was passed into law not too long ago, back on March 27th, and it was really the third round, I call it the third round of government stimulus that is designed to kind of help us all get past this pandemic. So just to remind everybody, some of the background on the first couple of rounds. Round one was about $8.3 billion, and that was money for health agencies providing for testing. And there were some also small business loan subsidies in that $8.3 billion round one. Round two was about $100 billion, and there was some tax credits in that round for employers to pay sick leave, and some increases in some of the unemployment benefits, and a little bit of food assistance available too. Round three, which is really what we're going to be talking about this afternoon, is the CARES Act. And this is a $2 trillion government initiative, and really designed to put checks into individual families' hands and individual citizens' hands, right? Support for airlines, air cargo loans and grants, not to mention some of the small business opportunity loans and/or maybe even forgiveness programs that are out there. But the piece of this that I want to focus on this afternoon is the couple of pieces that impact qualified retirement plans. And when I think about this third round of what's happening here, is it's really designed, again, I said this earlier, to get hands in the money of individual participants. So there are 3 optional defined contribution provisions that we'll talk about this afternoon. There's 1 mandatory defined contribution provision, and there are a couple of provisions in the CARES Act that provide for defined benefit plan funding relief. I'll talk about that a little bit towards the end of the conversations this afternoon. By the way, I forget if we mentioned it earlier. If you have questions, feel free to put it in the chat box, and we'll circle around and try to answer all those questions today. So getting into the first element of an optional feature that's made available, it's a waiver of the 10% penalty on certain coronavirus-related distributions. This is kind of a special provision that's been put into the law that essentially says if you're an impacted participant in a qualified defined contribution plan, you can potentially take a distribution of up to $100,000. That distribution is going to be exempt from the 10%, I call it the 10% penalty tax on early withdrawals. And I think it was Todd mentioned it earlier, we're running the plan, the qualified 401k plan for the Montana Chamber of Commerce. And what we've done is we've tried to make adoption of these features, by the way, at the plan sponsor level pretty easy and as painless as possible. And what we did, I'm just going to backtrack, law was passed on March 27th. Within a couple of days of that, we actually put together kind of a game plan in terms of how we're going to roll these optional features out to clients. And the one thing we decided to do is say, look, let's make it easy, right? Let's give every client the ability to automatically have all 3 of the optional features that I'm going to talk about. Or if, by the way, if they don't want to do all 3, you can opt out, and then we'll circle around at a later date and see if we can get you to opt in individually, if that made better sense. So again, we got on this right away as an organization. We're in communication with clients because, the overall goal is, to the extent that any of your participants were negatively impacted by this or do become negatively impacted down the road, we wanted to make sure you had the ability to get cash in their hands, which is really what this law is all about. So step 1, optional. You could add what I call a corona-related virus distribution feature. You could actually add this feature whether or not you have an in-service distribution option in the plan. And again, we designed it to be as easy as possible. So we didn't want to have you go through, well, let me amend the plan to allow in-service to begin with, and then let's adopt this CARES Act feature on top of that. So bottom line is, somebody who's impacted, and I'm going to get into who's impacted in just a moment. They could take a distribution of up to $100,000 free of that 10% excise tax or that penalty tax. The other thing that goes into this feature, though, is taxability. What the law says is any distribution that's a CRD, corona-related virus distribution, right, is taxable ratably over a period of up to 3 years. So you could actually choose to pay tax on 1/3 of the amount this year, 1/3 next year, and 1/3 the year after. Or in the alternative, you could actually pay tax on the entire amount this year. I believe there's going to be an option to do something different than 1/3 in year 2, right? So if I paid tax on 1/3 of it this year, could I pay tax on the balance of it next year? I probably can. We probably need to wait for some guidance from the IRS on that, but my hunch is we're going to be allowed to do that. So number 1, exemption from the 10% tax. Number 2, kind of a tax break that draws it out over a period of up to 3 years for federal tax and or state and or local tax. But there's another feature that ties into this, and it's the ability of a participant to repay or restore this distribution either back to the plan from which it came or actually roll it to an IRA account. So for example, if I took 50 grand out this year, and if I wanted to eventually pay it back, I can do that as long as it's within 3 years from the day following the day in which I get the distribution. So I could pay it back 3 years down the road or 2 years down the road. I could pay it back to a different source, meaning an IRA account if I wanted to. So basically, I can keep that money tax deferred for the long run. Now, you might say, well, wait a second. If I don't pay it back until year 2 or 3, what happens to the Fed income taxes that I paid in 2020 and maybe 2021? Well, you'll be able to file an amended return, amended federal tax filing to kind of get that money back if you choose to roll this money over down the road. So again, they built in, excuse me, a ton of flexibility here. The other thing you need to know is this applies to any of these corona-related distributions between from March 27th through December 30th. Kind of put a weird thing in the law. You would have thought they would have said, well, if I could take a distribution through year end, for some reason they wrote it through December 30th. So, the window is a relatively short window. Possibility it could be extended to the extent that this pandemic continues for some period of time beyond that. So with that said, that is one of the optional features under the program. The second optional feature has to do with Corona, I call them CRLs, Corona-related loans. So basically what they said in this law is participants would be able to borrow from their account. They doubled the normal loan limit, which is $50,000. They said you can take up to a $100,000 loan or 100% of your vested account balance, right? Anybody who knows the loan rules would say, oh yeah, normal rules are 50,000 limit or 50% of the vested account. So effectively loan limits are doubled. And the other restriction, they did put a restriction on this. Loans due to the virus are only good if you take them between March 27th and September 22nd. The way they wrote the law, they said CRLs, Corona-related loans, are only valid for a 180-day period from the day they signed the law. So September 22nd, this runs. Now, the other, and there's another aspect of loans here, the CARES Act extends loan repayment periods by up to a year. And this feature, again, optional, applies to both new and existing loans. So this one is kind of interesting because I need to think about this in a couple of different ways. So number one, if I took a brand new loan because I was negatively impacted by the coronavirus, right? Essentially, I don't really have to make any loan repayments right now this year. Because any payments that would otherwise be due, and the way they wrote this between now and year end, I can actually defer for up to a year. The second aspect of this extension on loan repayments actually also applies to any existing loan, right? So if I previously had a regular loan in my plan, I could actually request a delay of repayment or an extension of the terms of repayment. So this one is a little bit harder to get our hands around for a couple of reasons. Number one, other than writing the law, there's no guidance on it. Now, the only guidance we have is they're kind of going back to the Katrina days where they did something similar, but the time frames for those loans were vastly different. So here, essentially the way we're thinking about this now, pending guidance, is, look, basically assume, if I had 4 years to go on my loan as of now, I can essentially extend the repayment by up to a full year. What's in question right now is, well, do I have to re-amortize those loans effective January 1? I think the answer is no, because that means I'm not really deferring any payments for up to a year. I think what would happen is I begin my regular repayments January 1, and then any re-amortized payments would effectively begin next April, May, or June. So we're still waiting for guidance on that. Again, it's brand new. The whole intent of the law, let's get money in the hands of participants. Let's get it in their hands as quickly as possible to try to meet the needs of participants who may be negatively impacted here. So what I want to talk about next, before I get into the mandatory feature and the defined benefit features, is who qualifies, right? So again, just before I get into who qualifies, retrace quickly. Distributions are permissible. There are tax breaks on the corona-related distributions. Loans have been enhanced. The amount of a loan is potentially doubled. Loan repayment terms have been extended, right? And there's an impact on old loans too, where you can actually extend them. So those are the optional features. Now, who qualifies? So if you or your spouse or a dependent has been diagnosed with COVID-19, and COVID-19 is the, I always get this a little bit, is the virus, and SARS-CoV-2 is the disease, I guess, or I may actually have those backwards. But if you're diagnosed, you or your spouse are dependent with either of these, you qualify. There's got to be, and this is all in the law, it's got to be approved or diagnosed via a CDC, Center for Disease Control test. And I assume, when you have that test done, there'll be certain paperwork issued that confirms that test was appropriate. So those are the first couple of hurdles. Do you have the virus? Yes or no? Does your spouse or dependent have it? There are some other qualification requirements. And the next one talks about having adverse financial consequences, but then they get very, very specific. So, and the way they wrote the law, they said if you, the participant, have adverse consequences due to being quarantined, due to being furloughed, due to being laid off, due to having your work hours reduced, right? Unable to work because there's lack of childcare. And this last one talks about, this is more geared towards business owners. If you had to close your business or reduce the operational hours of your business because of the virus or because of quarantine guidelines in the state, you'd be deemed to be negatively impacted. So again, these 6 or so items are very specific to you, the participant, being negatively impacted. So we've gotten questions from some participants who have said, well, Rich, my spouse was laid off or my spouse's hours were cut back, therefore I should be able to take a distribution or a loan. And unfortunately, the law doesn't read that way. That's the problem, right? It is very, very specific when it says you, the participant, need to experience directly one of these couple of things. So that's the way that works is the bottom line. Now, in terms of certifying, right, that you meet one of those conditions, right? You either have the virus, your spouse has the virus, dependent has the virus, or you're one of those 6 other impacts. The law says self-certification is permitted. So basically, all qualified plans have fiduciaries who are responsible for the operation of the plan. In the case of the Montana Chamber Plan, we act in a fiduciary capacity. So in essence, whoever the fiduciary is responsible for proper administration of the plan and making sure the terms and conditions of the law and the plan are met. So self-certification is absolutely permitted. What we did is we created a self-certification form that can be used by participants, number one, to qualify themselves using those 6 or 7 or 8 different points. They need to certify and attest to the fact that they're qualified. The adopting plan sponsor, there's also a place for them to kind of sign off, but they're not necessarily checking all the details and all the facts. You can really rely on participant self-certification. The only thing the law does say is if there's a known reason, right, if we would know for an absolute fact that somebody wasn't negatively impacted, then there'd be an obligation to kind of hold up on it. But the bottom line is this whole law was designed to get money in the hands of participants who are in need. That's the bottom line. So that's how those couple of features work. All those features that I mentioned are optional at the plan sponsor level. They can be used as long as the plan is amended. This is another aspect of the law. the law says you got to amend the plan by the end of the 2022 plan year. So what we've said to all of our clients who work with us is, look, all we need you to do is, again, we sent a client level opt-out form. Basically, we said we're going to assume you're adopting these three features, these three optional features, unless you opt out. So we did have a handful of clients opt out because some of them said, look, I'm okay doing the corona-related virus distributions. I really don't want to get involved with granting plan loans. Okay, fine. So they opted out. We ended up circling back with them at a later date, and then they could opt in very specifically to the distribution feature, but not the loan feature. So again, we tried to make it as simple as possible and as effective as possible. We also told clients we're going to take care of the amendments for you by the end of 2022. As an additional matter of community service, good faith to our clients and participants, we actually waived all of our fees on this stuff, right? Because normally if you're taking a loan or a distribution, there'd be administrative fees to do that work. So we said, you know what, it's the right thing to do. People are negatively impacted to something way beyond their control. So we said we just didn't feel we could charge money to help people out. So that was our contribution to this, quite frankly. I'm not going to talk about governmental plans. I don't know that anybody's on the line with that. They do get an extended due date on all this stuff. So the next aspect of CARES Act, and this one has, in my view, provided some confusion out in the community or out in the marketplace in general. But basically, the CARES Act says there is no such thing as a required minimum distribution for 2020. So, anybody who otherwise would have needed to take a required minimum distribution this year is not required to do that. Now, those people come in a couple of different, I call them flavors, right? Somebody who otherwise would have been 70.5 this year. I either have to take my distribution this year or by April 15th of next year. But there's another category of people who turn 70.5. I'm going to rephrase what I just said in a minute because there was a different law change impacting that. Somebody who turned 70.5 last year could have taken their minimum last year, or they could have delayed it until April 15th of this year. So those people don't have to take it. And in fact, if they did take it, they can actually roll the money over, and I'll get to that in just a half a second. Let me just adjust what I said about somebody turning 70.5, right? The Secure Act passed on December 20th changed the required minimum age to age 72, and that's effective actually this year. But bottom line is there still could have been first-timers for a variety of reasons this year on the minimum. So minimums are not required. And you might say, well, why did they change that? Did they just want to give us a tax break? And the answer is, if you think about what happened, and we've actually come full circle on the markets almost, but if you think about where markets were, stock markets and asset prices back on December 31, and if you think about where they were when this law passed on March 27th, markets in general, certainly U.S. markets were down, 30, 40% due to this pandemic. And I'll give you a numerical example that would be easy to follow. If my account balance was $100,000 at the end of last year, and if I had to take my minimum required distribution this year, and let's say the math worked out that I had to take a 4%, I'm making this up, but a 4% distribution essentially. So I'd have had to take about $4,000 out of my $100,000 balance. But if between the end of last year and the end of March, my $100,000 was probably only worth about $60,000. But if I still would have had to take that 4 or 5% out, now my $60,000 is only 50, whatever my math is, 55 or 56,000. So quite honestly, between the distribution and the market action during that time frame, my account's been cut pretty much in half. So again, the law was designed to say, look, let's give people relief. Let's not make them take minimum required distributions at inflated asset prices. Now, quite honestly, where we sit today, there's been a huge rebound in the market since the low I think the low was March 23rd. So this waiver is an absolute. Now, I know, unfortunately, there are other providers out there who are kind of saying, well, we'll continue to do it. Well, guess what? The law says there's no such thing as a required minimum. That's what the CARES Act says for 2020. So even if I've been taking required minimums for years, I don't have to take it this year. And if I did take it, bottom line is I can pretty much roll it over. So, yeah, I know that there were some major, I won't get into all the nooks and crannies of it, but the law is very, very specific is the bottom line. So what we did as an organization, just to let everybody here know, we said, look, we can see individual participants looking at this two ways. Number one, my first example, gosh, my account's been decimated by markets. I really don't want to take that distribution, and I'm only taking minimums because maybe I have other sources of assets to use for the time being, or maybe I want to keep these assets tax deferred, so on and so forth, whatever it may be. So we wrote everybody, and we said, look, if you're scheduled to take your minimum later this year, you don't have to take it. But if you want to take a voluntary a voluntary distribution from the plan, just let us know. And by the way, here's the amount we would have been paying you as a required minimum. Let us know if you want to take that same amount, and we'll send you get you the money, so to speak. So, some minor differences on a required minimum. There's a mandatory 20% withholding, federal income tax withholding on that, unless you opt for a higher amount of withholding. On any other distribution, there's no mandatory withholding, and actually the withholding starts at only 10% unless you alter that amount. But bottom line is there's no mandatory withholding because you can technically roll that money over. So we do have a bunch of people who took required minimums earlier this year, and there is an ability for them to roll that over. And they actually came out with some guidance and relief, right? Because we were a little bit worried about somebody who might have taken a minimum on February 1, let's say. And normally to roll money over, you got to do it within 60 days. But long story short is in the interim, they've come out with some guidance and extended the ability to roll that money over at least through July 15th. So, and maybe there's more relief on this stuff coming down the road too. So another, this one, by the way, this slide I have up is not a CARES Act provision. However, it's just something I wanted to remind everybody of, that you can potentially suspend safe harbor matching contributions, for example, if it makes sense and if you as a business owner have a need to do that, right? So there are certain requirements that come into play to do that. You do have to give a notice to participants, I think at least 30 days before you do it. If you're interested in doing that, or if you need to take some action, you can always call us and we can kind of walk you through. We do have to make sure the appropriate language was in your participant disclosure notices to enable you to do this, but it is something that we've had a handful of clients, plan sponsors looking to do to kind of spare some expense in the interim. So obviously, if you, by the way, suspend safe harbor contributions, your plan is going to be subject to the regular average deferral percentage and average contribution percentage testing rules. So that's out there. I'm going to mention, I don't know how many of you have defined benefit plans. I'll go quick, and if you want more on it, I can give you more, but it's really pretty simple. They gave us two things in the, and actually this is not CARES Act. This goes back to, oh my gosh, I'm trying to remember if this was Secure Act or just other relief that came along the way. But basically they said, look, if you have a required contribution that's due to your defined benefit plan this year, essentially you can skip making the contribution. You can make it on January 1 of next year. You do have to pay interest on it, so on and so forth. So they're kind of saying, look, you can kind of skip your contributions. The other thing they did is for certain lump sum distributions, they said you can use the same funded ratio rate that you used in the previous period. So I won't get into all the technicalities of that. And that's what I'm talking about on this slide here, benefit restriction relief for certain single DB plans. So again, if you run into any of those issues, we can certainly help with additional detail on that. A couple of other things occurred along the way. I think this relief was issued on, believe it or not, March 31st, separate from the CARES Act. basically said to anybody who had to do a restated plan document for a DB or a 403B plan, you had an extended due date till July of this year. Quite honestly, the due date was the end of March anyway, or it was April 1, I forget which, but so like on the very last due date, they said, oh, we'll give you more time. So we didn't have any of these issues with any of our clients. These were done well in advance, but I just wanted to mention that was out there. Other things, on some of the extensions of time, they gave us until July 15th. I think everybody probably knows federal income tax due date has been pushed off from the normal April 15th until mid-July now. You didn't have to do an extension of time to take advantage of that, and they're going to give anybody, at least I believe they're going to give anybody who owes tax money some relief on the interest payment for the interim period for this extended period. So that was another nice thing. They also, again, this is additional relief that has kind of come out since the CARES Act. Plan loan repayments, there's an additional relief on that than on any loans that were payable by participants to the plan. You have an extension of time to correct a failed ADP or ACP test. I mentioned this earlier, this next one, there's a window to roll over eligible, required minimums that you took earlier this year. You have an extended period of time to roll that over. An extension on some of the 5500s that were due, and 90-day deadline to withdraw from certain employer matching contributions. And there's taxation on restricted stock, which I didn't get too in depth in because that's not really in our wheelhouse. There is additional authority out there for DOL and or IRS to provide some additional extensions down the road. But I think what I want to leave you with is a couple of things. CARES Act was designed to be as straightforward as possible, right? Not to mention the nearly 1,000 pages of text on the legislation, on the law itself. In the retirement side of it, as I mentioned, there's really just three options. One is the distribution, one is the CARES Act loans, and one is the extension on loan repayments, right? Those are the three optional features. We designed it to make it easy peasy, so to speak, opt out if you didn't want them. I didn't mention this before, at least I don't think I did, but the other thing that we decided to make easy is you didn't have to amend your plan to put in a loan feature or put in an in-service distribution feature before you adopted these. I know some other providers in the industry were kind of saying, well, you got to adopt a loan feature first, then you can adopt the CARES Act. Well, here's our view. Law was intended to get money in the hands of people in need. To make a plan sponsor go through the rigmarole of doing all that other work, even though they gave us an extended due date till 2022, guess what? That's the due date. And our view is you can specifically adopt these CARES Act distribution or loan features, even if you've never had those other features in your plan, and even if you never intend to put them in, is the bottom line. So that's it in total. We think we help clients to a great degree in terms of kind of getting through this part of it. People have asked me, one other quick, right? People have asked me, do we see any other relief coming down the road? The answer is, yeah, I think I do. I know there is a House bill kicking around, and I'm not sure that version of it is actually going to get through. But I potentially can see some additional, relief coming through down the road there too. So with that said, Todd or Mike, I don't know if we got any questions from the group.
Yeah, we've got a couple of questions here, Rich, that we can kind of roll through. So thanks for that update and some of that information. I think probably the screen that we're seeing now probably sums it up the most is that there are options with regard to your 401k program, but it's probably best to coordinate with someone that knows how to navigate it, right? This is not something that I think probably the average citizen just goes and says, I'm going to take advantage of this CARES Relief Act as it relates to my 401k, but they probably need a little help in navigating what it is they can and cannot do and what some of the implications of that might be. So thanks for kind of giving us a sketch of some of those sort of options. At the beginning, one of the questions that came in at the beginning of the presentation, Rich, you referenced that there's a penalty for taking a loan from your 401k. And then you also referenced that, there's a 180-day period of time. Can you explain that just a little bit more? Is that they have to take that within the 180-day window, or I think there appears to be some confusion about that 180-day window.
Sure. Let me explain, hopefully clearly. So on the loan feature, right, on normal loans, participants can borrow up to 50% of the vested account balance, or 50,000, whichever is less. The CARES Act loan basically said, hey, you can borrow up to 100% of your balance, but no more than $100,000. So the loan limits are doubled. There's no excise tax or additional tax on the loans. I don't know if the question is kind of coming from, I thought I said there was an excise tax or the additional tax on corona-related distributions, right? The in-service distributions prior to age 59 and a half. So if I didn't say it that way, that is what it is. So, but let me get to the 180-day period. I went through the qualification requirements. Assuming you're qualified to take the corona-related loan, that loan has to be requested between March 27th and September 22nd. They kind of said for the 180-day period beginning on the day this is signed into law, the government is saying you can take this type of a loan from your plan, assuming the plan sponsor agrees to put that feature in, right? So it's kind of a window that for some reason they said 6 months, 180 days roughly, is the time frame to request the loan. Let me just add to that a little bit, just because again, I did talk about the distribution aspect, and that for distributions, they said you could actually take a distribution no later than December 30th. So they kind of gave, a different window period, right, for corona-related distributions. The other twist on distributions, I actually could have taken a distribution before, an in-service distribution before the CARES Act was signed into law. And believe it or not, I can actually claim that as a corona-related distribution because the way you qualify yourself in any event is on your tax return for the distributions. Right? They're going to enhance the tax, the 1040, and basically say, hey, are you a corona-related virus impacted individual? You probably check the box, yes. Did you take a distribution due to this? You check the box, yes. And that'll kind of enable you to opt into that 10% tax savings, right? The early withdrawal tax savings, and enable you to pay taxes over a period of up to 3 years, and enable you to repay, if you want to, that distribution over the next 3-year period. Hope that helps.
Got it. Yeah. No, it's complicated, right? And there's a lot of tricky waters there to navigate. So thank you. So here's another one. As it's related to COVID-19 impacted individuals. If your spouse was laid off, does that qualify you as COVID-19 impacted?
So Todd, let me answer that 2 ways, right? So if my spouse is negatively impacted, has the virus, right? If my spouse is part of a qualified plan, they could potentially, right, take a distribution or a loan. I can't though. Well, hang on, I take that back. Let me go slow. You said if my spouse has the virus, is that right, Todd?
No, if your spouse just got laid off, right? And
I'm sorry.
Yeah, if your spouse, let's say your spouse got laid off because the company that he or she was working for had a big layoff because of COVID, right?
Yeah.
Slow down work or something.
Yep.
Does that apply, or is this just do you have to have the actual COVID family, right?
Yeah, right. If my spouse is laid off or whatever, I can't self-certify based upon that.
Okay.
That's correct. Right. I can only self-certify if they had the virus, or right. That's where I would. Okay. So that's clear.
Okay, great. Let me see what we've got else here. So I'm just going to read this question to you, and you can help sort it out. Are there testing preview reports a plan can run in advance of terminating the safe harbor for 2020?
Oh,
This
yeah, that's a
also
good.
help determine the advisability to the termination.
Yep. So basically,
I don't know what that question is asking, but I assume you do.
I do, as a matter of fact. So whoever asked the question is saying, hey, I have a safe harbor 401k, and because I have a safe harbor, I don't have to do testing, the ADP and ACP testing. However, if I want to suspend that safe harbor, can I find out the estimated impact? And the answer is, yeah, we can do. We used to do this as a regular course of business, run what we called mid-year tests.
Gotcha.
We used to do that a lot when we didn't have a lot of safe harbor plans, and it would give you an idea as to whether or not the plan would pass or fail. And the short answer is, yep, we can absolutely do that kind of work. Easy to do. We just need the data, and we can walk through it.
Okay, thanks, Rich. What about a 401k plan that only allows for complete distribution of the entire account balance, or RMDs, for terminated participants?
Yeah, it's a really good question, right? Because, and that ties right into one of the other points I was making. So the plan says you can only have your money two ways. If I have to give you a required minimum, yeah, I got to do that. Or you can either take all of your money or none of your money, right? That's I've seen there's more than a few plans that are designed that way. So here's our interpretation of what the CARES Act does. The CARES Act says we don't really care what your plan does or doesn't say. If you adopt a CARES Act distribution feature, right, you're going to then say to any participant or terminated or retire, you can actually take a partial distribution. So partial distribution account. So let me paint the picture, right? The employee has a $200,000 account balance. They're negatively impacted by coronavirus. The plan adopted or opted in or didn't opt out, let's say, for our clients, of the CARES Act distribution feature. So notwithstanding what the other portion of your plan says, we're going to say that participant, if they qualify, could take anywhere from $0 to $100,000 corona-related distribution, right? So to me, in the way we are looking at this, that would override any existing plan provision. So let me make one other point here. So if that client was adamant about not wanting to do, quote unquote, a partial distribution, right? My $200,000 account, I got $100K, corona related. If I don't want to do that, I could not adopt. I don't have to adopt this optional feature. Is my point. That plan sponsor could say, yeah, that's fine. We're not going to make it available. Now, here's another trick for the participant. In theory, they could take their $200,000 account if they're otherwise eligible to take it, and that would probably only apply to terminated people or people over the age of 59 and a half who potentially can do an in-service maybe. They can actually take the whole amount. They could roll half of it. They could treat up to $100K as a corona-related distribution because they're the ones who are going to self-certify to that on their tax return. So, Todd, I won't get too deep on it, but there's a couple of strategies there. But at the sponsor level, they either opt in or opt out of that feature, and it overrides whatever else they may have in the plan.
Got it. The age 59 and a half restriction, does that apply to the CARES Act?
No.
So if I'm,
no, basically,
in my case, I'm 53, right? I could do this under the CARES Act?
Yes, absolutely. Absolutely.
Okay. I have one more question here. Let me get it. Oh, are there any issues with union plans or prevailing wage plans?
I don't see any. Interesting. I didn't really talk about that today. I didn't see any restrictions or any different treatment in the law for those types of plans. Now, the one thing you need to keep in mind, these optional features have to be adopted by the plan sponsor, right? So to the extent that that plan adopted the features, they're available. If they didn't take any action, well, then they're not available. But that rule applies to any qualified plan. The RMD exemption for 2020, that applies to everybody. That's just basic law that came out of this thing. So that's a mandatory, but all the other features are optional. And if that union or collectively bargained plan had adopted it, then they're available. Best thing to do is ask the quote unquote plan administrator, which is probably starting in the HR department. Yeah.
Great. Well, I've got all the questions that were queued up answered. Thanks again, Rich, and to all of you at Pentegra and UBS for agreeing to host this little webinar. Like I said at the beginning here, it appears that there are plenty of options here. It's just a matter of making sure that you talk to someone that is an expert in this field to help you navigate what some of those options are. And I'll just do one more plug here. Mike, if you have anything to close out, I'll throw it over to you. If not, we'll just wrap it up. The Montana Chamber, we've teamed up here with UBS and Pentegra, on a retirement program to take that sort of liability and headache off of your plate. And so if that's something that would be something you'd like to offer to your employees that you're currently doing, or you'd like to start offering it, we've got a plan that we think would work for you. And thank you all for joining. Mike, do you have any closing comments that you might want to throw at us?
Yeah, I'm just going to briefly introduce my partner, John Camprath, who is also on our senior retirement plan specialist team, and he's got just a brief comment or two. John?
Great, thanks a lot, Mike. I appreciate it. And thanks, Todd, and especially Rich. It's been an excellent presentation so far. And on this closing slide, obviously, it says we're here to help. That's obviously the Chamber, but really the Chamber's partners. So we can get access to, the actuaries, to plan consultants, to Rich at Pentegra. If you have questions on how to implement maybe some of these new features or new options that are available to you, something that we've found going on kind of currently here with a lot of plans is that as you're kind of reflecting on your business, maybe trying to work on the business and make the business just more solid. Next time we go through an extended kind of period of challenge, whether it's a recession or just a relapse of the whole COVID experience, we've been unfortunate to have to go through. But looking at things like benefit programs and looking at plans and wondering how can we benchmark our plan so that we know that we're really being very, very current, very lean, but very efficient with the resources that we're allocating to these benefits. Feel free to reach out to us because we can help you benchmark that plan, whether it's just, an assessment of your plan design to what are you paying in fees and how much liability are you still hanging on to? Because obviously as an ERISA-based plan, all the named fiduciaries on your retirement program, you all have as fiduciaries a personal liability that you can't hide behind the corporate shield. Well, we can show you how maybe there's some great trade-offs by partnering with experts like Pentegra and UBS, where you can not only outsource the work, we all think of outsourcing our 401ks to professionals, but also outsourcing the liability that comes along with that. So give us a call. Our numbers are there. You can always learn more about the plan at montanachamber.com/retire. There's a great little 2-minute whiteboard video that'll explain our program and the unique benefits that come with it. So I just challenge you to look at that and maybe pick up the phone and call one of us here at UBS or Ken Jackson, which is one of our colleagues here at Pentegra, to assist you with any kind of benchmarking or questions or just thoughts for how to implement what we've just talked about. Look forward to hearing from you. Thank you. Back to you, Todd. Thanks.
Thanks, John and Mike, and of course, Rich. And I want to also make sure I give a quick thanks to our Treasurer of State members, some of our best supporting members of the Montana Chamber of Commerce, First Interstate Bank, State Fund, and Northwestern Energy. Thank them for their continued support of the Montana Chamber of Commerce. Thank you all for joining us today. And if you have ideas on other webinars of issues that might be of interest to you, please feel free to reach out to us directly, and we'll chase those down and provide those opportunities going forward. So thanks again to everyone.